Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over Twitter. We're going to check out and see what information's being shared on, I guess it's called FinTwit. I'm going to give you my financial opinions. It's probably going to be related around commodities, housing market, interest rates, financial type stuff. If you need any help with anything, definitely check out finding-value.com. Become a part of our community. You can use the word discount in the coupon code, get yourself a little bit of a discount. And we do have a 5 p.m. Mountain Standard Time Sunday question and answer session for members that are looking to ask questions. You can ask me directly during that time frame. So let's dive in here and see what we got on Twitter. Again, if you want to follow me, it's at finding_finance. So I've got real estate, Homebuilders. It says MTH, that's Meritage Homes Corporation, looks strong to me at all-time highs. Lenner is also looking beastly. The housing market boom, right? Where are all my housing bears at? So this is MTH, Meritage Homes Corp. If you kind of look, we're squeezing up and basically going to break to the upside of this thing and have a monster run, most likely out of MTH. Lenner Corp's another corporation that is also broken to the upside, done a retest, and is breaking and basically at new all-time highs or very close to new all-time highs on a logarithmic scale. So if we're in a housing crash, then why are all the home builders, or at least these two home builders, why are they looking so good? How could they be so good? If we're in a housing market crash and an oversupply state, we would not have home builders be where they're at. They peaked in 2005 of last bull market and headed lower. The crash came after the home builders peaked and were rolling over. No crash, as far as I can tell, in a lot of these home builder stocks. And obviously, these are two of the stronger ones. But yeah, I don't see a crash there. At least not yet. And I said, yes, these charts are screaming at top, LOL. We've got Elon Musk here. It says, if you increase the money supply, you get inflation. That's what Elon says. He also said that it's a ratio of how much money that is created over here to the GDP. And if they go up in tandem, you get no inflation. He's partially right and he's partially wrong. Not with that description there, but money can go into the system and it doesn't necessarily. So M2 money supply can grow, but you won't get inflation in the system. We saw that here. Actually, I'll pull it up, show you what I mean. 1 second here as I yank up the M2 money supply to GDP. So what he was saying is as long as this is in balance together, you don't get inflation. So this is not inflation, but you don't see inflation in the consumer price index, even though your M2 money supply can go up faster than your GDP. Where money can go is it can go into financial assets and hide out in financial assets without impacting the consumer price index. It impacts the consumer price index under certain market conditions. So when you're under certain market conditions, namely, a larger demographic coming into home buying years, and that money gets into the system and money starts to rotate differently in that system, then the money is seen in your consumer price index because it goes into certain assets. There's your cycle. And right now we're in an expansionary phase of real estate. That's why the home builders are going and making new all-time highs. That's why money is being seen in the consumer price index. That's the step maybe he didn't connect or doesn't know about or whatever. Maybe he does know about it and didn't explain it well enough. Who knows? So there's that there. It says, it looks like Bernard Barak's old saying is coming true. The main purpose of the stock market is to make fools of as many men as possible. Fund manager, most overweight bonds since global financial crisis on absolute and relative basis. Latest B of A fund manager survey highlights. So the fund managers are most overweight bonds. Look at 09 and look at April of 23. That's crazy in my opinion. So generally everyone's on the wrong side. I remember the crash in March '09 was like the best time to be buying stocks of any time. What was it? I went long some diversified mining companies, I think in '09 that were just incredibly cheap. And they just crushed it over like 3, 4, 5 year time frame, which was tech. I went long tech Kaminko, was I think the name of it back in the day. In that, and it was like $2 or $3 at the bottom, and it went all the way to like $30 in like a heartbeat. That was pretty cool. But they could all be positioned wrong, and guess what? That's fuel for money to rotate back over, fuel for equities to go up. If you notice, the bottoms here, they all went up quite dramatically after it. So that's kind of cool. We've got let me go back to my profile. So coming on down, we've got Dow Jones and gold ratio headed to single digits if the bear flag breaks down. Eventually, sub 1 is a possibility over the coming years as a secular bull market and real assets take hold. Totally agree with that. This is your long-term kind of movement. You got 1, 2, 3, 4, 5, 6, and then we're going all the way back down here potentially, and that is below 1. What that means is that gold could potentially be priced at a greater value than the Dow Jones Industrial Average, at least priced in dollars. So that ratio could drastically go down and crash where gold outperforms the Dow Jones Industrial Average. We got the macro guy. This is why I think something's going funky in this market here, guys. He says the debt ceiling fear is causing chaos in the bond markets, significant decoupling between the 1 month and 3 month US Treasuries. And you can see how these are pretty well correlated and the spread is pretty close. Look at the spread here. We're 3.89 and 5.2. It's like they're diverging here between the 1 month Treasury rate and the 3 month Treasury rate. And I think that's why things just look funky to me. It's kind of weird. I look at yields and I'm just like, what the heck is going on here? And this divergence is just funky. It doesn't make sense to me. It happened like this. It looked like it happened like this in late 2022 as well. Big divergence, and then it caught back up. We got this big divergence. Maybe the 1 month is going to spring back up to the upside or something. Largest tech layoffs since November of 2022, Amazon, Meta, Google, Microsoft. Now, you get all these tech layoffs. You know, a lot of people say, oh, recession, this, weakness, layoffs, people can't afford to buy homes. Guys, the housing market and the increase in interest rates is causing these layoffs. This is a part of the cycle. Go look at the 1970s and the unemployment. Go look at some of these other areas like the mid 2000s. When interest rates go up, tech suffers because money flows out of tech. It flows away from it from an investing standpoint and flows away from it from a retail standpoint of people buying products. If they can't afford to buy, you know, they're gonna go buy food before they buy brand new technology, gimmies or gimmicks or whatever you want to call it. So these are the ones that get hit first generally. It's because their stock prices go down because of the increasing interest rate environment because they're growth stocks. And then their revenues could potentially fall as well, given the tightness in the markets and the inflation and all that stuff. Here's oil. This is Hinster. He says back test for a friend. This is oil. You've got a trend line coming through here. We've gapped up above that. Could we come back and do a retest? That's my best guess as well. Maybe it's like $75, $76, something like that, wherever it is. So oil could pull back to that. Yeah, that's fine. I think it'd be one good buying opportunity. Coming on down, despite calls for its demise, global diesel demand is ramping up, buoyed by exceptional strength in Asian reopening and European resurgence. North America has stabilized on trend, and South America continues to grow transportation and farming demand. Trust data, not narratives. And I know we've got a lot of people that I follow. They look at the demand. It's demand, 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 demand. This is diesel demand in Europe surging the past weeks, flattish for the rest of the world. And everyone is really focused on the demand and supply of all of these commodities, but there's also the supply and demand of credit. Both of those things determine the pricing of commodities and has an impact on the demand of those commodities as well. If more credit's in the system, there's more demand for basically everything. And the number one commodity, oil, will have more demand as more credit is in the system. If more credit gets destroyed or deleveraged out of the system, it will reduce the demand for oil. But right now, we're not seeing a deleveraging. We're seeing more. We're seeing strong housing starts, and around the world, there's very strong demand growth for oil and energy in general. So the demand's there. Now we just have to get through the worries of this recession / credit stuff going on in the system, the banking crisis, however you want to call it. We've got the gold to S&P 500 ratio after yield curve inversions. So after the yield curve inverts and then we basically uninvert, this is 2-year average performance after the yield curve inversions. So the gold to S&P 500 ratio today, if we're looking in the green here, and this has been the path of 1973, 74 of the recession and tech bust in the blue. And then the yellow is by 70% since 1970. So there's two areas here, and we're just kind of tracking after the yield curve inversion. So gold usually outperforms the S&P 500. That's what we're seeing too. We're seeing gold breaking to the upside, looking pretty strong. And I think that is what best correlates with the yield curve inversions and then uninverting. Okay, here's my boy Platinum. A weekly close above $1,100. And all lights are flashing green long term. So this is Platinum in US dollars. And we're starting to break to the upside here, guys. It's going to get fun. My boy Platinum. There we go. So JP Morgan priced in Platinum. I haven't really seen anyone price anything in Platinum, but hey, let's do it. Carving out a massive top. Very bullish for gold, silver, oil, and uranium. You've been warned. Platinum is an inflation metal. Very inflation sensitive. You can see that we topped out here in the late 1990s, and then just ripped it all the way down to the bottom of 2012, where 2012 had a face-ripping JP Morgan just killing it all the way to the peak here, and we're about to get jiggy with it to the downside. We break this to the downside. You can see the lower highs here, the distance from the moving average. We're really coming up, bumping and grinding on that moving average. And yeah, at some point we're gonna, break through there. We're gonna break through with all that bumping and grinding, and head to the downside. This is Austin Schmidt. Don't really know who he is, but let's read it anyway. So silver supply was flat with mine production falling while demand is surging. This is a supply deficit of about 22%. It will be volatile, but silver is going higher, much higher, according to Austin Schmidt. So we've got 2022. You can see mine production down a little bit. Yeah, down a little bit. A little bit of recycling, throwing in some circuit boards or something like that, get a little bit of recycling going on. Total supply, it's roughly flat. Demand, we've got higher industrial demand in total, 556 versus 530. We come on down here, net physical investment. Ooh, that's a pretty big surge in net physical investment. We also have net hedging demand, which has gone up dramatically. So total silver demand is 1,242. I think that's in thousands or something. And then 1,055. You can see that we are over by 20-something%, 24%, 23%. We've got more demand than we do supply. We are in deficit land right now in silver. So that is good. We have entered deficit land. Coming up, we've got XAG USD. So this is silver priced in US dollars. It says if this is all what we're going to get to the downside, then brace the next big, gigantic move in silver. Um, this is what he put from this guy, the bottom to the top. This would be a pullback if we get a pullback somewhere in here. And he's saying, well, what if this is all we get? Maybe we get a rocket launch higher. I don't know. The short term stuff, guys, I'm not like a huge fan of the short term. What I try doing is just buying when things are relatively cheap. I cost average in. And if the ratios are incredibly cheap, I usually make a boatload of money as long as I can wait a decent amount of time. I've been buying platinum since 2019. It's been maybe 3.5 years. I really went big in 2020 when everything kind of fell apart. And I've just been riding this thing, enjoying the whole ride and accumulating as I go when platinum's been cheap. I've been doing the same thing with oil, the same thing with copper, diversified mining companies. I've just been buying when it's cheap and then holding on. I think the hardest thing for most people is just to hold on and not do anything. It's like they have to constantly do something or constantly make adjustments and shifts, and they think that that's working. I don't know. It just seems like I get afraid if I want to do gigantic shifts in the portfolio because trying to time the short term is really difficult. And if you can buy it when the ratios are really cheap, it just seems like it works so well. Buying physical metals and doing the physical ratios of the metals, I think, is a really low risk way of playing this because it's a way that like forces you from like making stupid decisions or emotional decisions. Making emotional decisions may not be the smartest move, put it that way. And it keeps you from doing that. And I've just made the most amount of money doing that, like a lot of money doing that. You can also pile in because the risk is so low. So buying the physical metal and then swapping it to something else later has worked out incredibly well for me, incredibly well. And you don't see your account values go up and down so much in the short term. So yeah, gold is close to taking off. Are you worried? I'm not. I kind of am worried to some extent, guys. I mean, I feel like this whole market is just ready to just rip it to the upside, but I also feel like inflation is just it's going to go ballistic or something. And that's what scares me. It's like, do I go and I buy all my stuff now, or do I just put it all in these investments, which I already done anyway, and just watch them all go ballistic? Hopefully that's the case. But yeah, it's right there. It says bullish consolidation above an early breakout line, still looking great. Non-reporting small speculative longs breaking out. Everything's kind of breaking out here. It looks really good for gold. I thought this was really cool. This Rashid guy, he put up a fractal. I love fractals, guys. I do. He says, might have bottomed today by testing 1969 mark back in 2020. Gold formed a similar pattern, and having bottomed in May, it rallied 24% within 62 days. It says, if this scenario were to repeat, then gold could rally towards 2350 to 2500 level by August of 2023. And this thing looks like the same fractal. It looks very similar. You can see these movements in here and the same type of movements. The fractal's roughly the same. May here, April here, which is where we're at. And we could see a big old move to the upside all the way till 2300, 2500, whatever it goes to. But very cool looking chart. I really do like fractals. I like how this is all playing out and how they're very similar. Good chart there, Rashid. Cornerstone Analytics says, we've told clients that OECD oil inventories last month fell 5 times more than normal March rate. 15 minutes ago, EIA data indicated U.S. crude inventories dropped 6.2 million barrels last week. Inventories keep falling. Global demand remains strong. Stay focused on the damn data. So that's his opinion there. I agree. Again, I think it's a battle between physical demand and then the credit stuff. Interest rates, credit, and I know sometimes these go counter to each other. And I think eventually the inventories falling is going to force prices higher at some point. When is that point? I don't know. But I'm going to stay long because I think that there could be very big imbalances coming towards the end of 2023. The imbalances were there in 2022. They just flooded it with SPR barrels. That's what kept this all in check. So a lot of us, I think, had it right. But maybe what we had wrong was the barrels that were going to flood onto the market from the SPR. As the SPR gets drained, that is not an option in the future. I put on here commodities to outperform over the long run. So we've broken that new paradigm where commodities will outperform. We've got that there. I said platinum, oh la la. So we've got platinum here. We've broken to the upside, and this thing looks fantastic to rip it, guys. Gold platinum. I'm obviously probably one of the world's biggest platinum bulls there is. I was buying in 2019, right, kind of down in this support level. It started taking off, and then we came all the way back down. I swapped all of my palladium for platinum, luckily, in April of 2020. Ratio was just dirt cheap. Bought a whole bunch, all in 2020, 2021. I didn't buy as much in 2021, but there's a lot in 2020. I bought a whole bunch in 2022, and I was buying some even here recently of the physical metal. This is part of my strategy to accrue more metals using ratios. That is a big part of what I do on the website as well, is I use ratios to determine value, and I look at a whole bunch of different even companies against the underlying commodities. So we do these gigantic ratio games, so to speak, and it's kind of fun, and you can make a ton of money doing it. It's not a get-rich-quick scheme. It's a investment, investing for wealth protection, growing your wealth, and it's protecting, growing, and doing it in a way with the least risk possible. The physical metals, that is. We've got the platinum to gold ratio. That's one of the ratios I always look at. And man, look at this thing. We've got a big green fat candlestick. The green army's showing up here. We're at 0.55, guys. This is super cheap. I swap my metals, some of my gold for platinum down here at 0.3 something. Just absolutely ridiculously cheap. I think it was 0.35 or 0.37 or something like that. But we could be heading higher here soon. Platinum versus silver. It's outperforming silver here just recently. We are very cheap for platinum against silver. And platinum is very much cheap against silver. So if silver is one of the cheapest assets in the world, platinum is far cheaper than silver. And then we got platinum versus palladium. 0.67 is the current ratio, and it is cheap and starting to outperform palladium. But palladium could also start to wake up here. We could have a run where platinum could maybe be outrunning or running faster than palladium, which palladium could also be running on up. So maybe platinum goes ballistic. I don't know. We'll find out. I'm not going to claim that it's going to be that, but it's the cheapest on a ratio basis of all the metals. Gold's still looking very strong. These are my charts. Again, we're sitting on top of all of this resistance. I'm pretty easy with charting. This is a cup and handle pattern. We've broken to the upside. Everything looks a-okay to me. This is zoomed in on it. You can see we have a wick at the bottom. Some buyers bought it up. I still think it looks really good for gold. Gold Ventures, this is platinum, monthly pushing to break out. I love this, guys. We're about to break out. We're at 1,100 now, so we actually broke out of this downtrend line. Huge move for platinum. I'm a gigantic platinum bull. I love platinum. Sorry, just have to keep saying it. But that's what I've got for today, guys. And platinum's looking really good. Gold's looking good. Silver's looking good. Physical metals look good. I still don't think oil looks that bad. Uranium, we'll see where it goes. I know some people are, how's uranium doing? Uranium's all right. I mean, I'm just waiting for it to make a move. I want to see it go up and move in it. I already have basically my positions already locked in place for the most part in uranium. Could I buy more? Yeah, I will if I start seeing some strength. I'll buy into that strength, no doubt. But yeah, I mean that's what I'm seeing in the markets. Everything looks really good, and I'm not afraid. I know some people are afraid, but I'm not too afraid of the markets. I think the charts look really good across the board for the most part in commodities. I think copper looks excellent, platinum looks excellent, oil looks excellent. Everything looks excellent to me. So yeah, everything looks good. Let's keep watching it and see how this stuff plays out. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already. Subscribe to the website if you'd like to join our community. I'd love to have you there. And that's all I've got for today. So we'll see you next time. This is Finding Value.